Definitely. I think right now it's really a situation where all systems are go, and it's time for the market to start moving higher. It's been flat for almost a year, and earnings have been flat, but the tone last week completely changed. The Fed basically said, if you could sum it up, that interest rates are going to stay low for quite some time, and we think that could be as much as several years. And with the 10-year note hovering around 2%, as Rick Santelli was just saying, and the 25 bips on the 10-2, that really supports kind of a 20 PE ratio on the S&P 500. So we've really turned bullish on this market at the moment.
Jeff, you're a little more nuanced here as I read it.
Yeah, I think that's right. I mean, I think Randy and I generally agree on the direction of the market, but maybe the timing is a bit off. I've been saying generally around 3,100 is probably a reasonable level for the end of the year. I think we probably end up sort of plus or minus 50 points on that. I think the upside could be somewhat capped by the fact that the economy is still in the later stages of digesting tighter financial conditions via higher interest rates that we saw throughout 2018. And it won't really be until the first quarter of next year that the lower interest rates we've already experienced start to act as a tailwind. And I do think, although trade is moving in the right direction, probably still somewhat of a wild card until things are set in stone a little bit more. I think the downside is still limited from the sentiment backdrop and the positioning backdrop just not being extreme, whether it was the Barron's poll a couple of weeks ago where 31% responded bearish. That's the highest percentage bearish in over 2 decades. CFTC positioning is only marginally net long, so nowhere near what we saw at the tops in the beginning of 2008 and toward the end of 2008. So I think there's a little bit of a range here, but I do agree as we move into next year, you start to see a more obvious bottoming in the global manufacturing cycle, and then you see a much more aggressive rotation into cyclicals that we would then trade into.
Randy, why do you say avoid Facebook and Google?
Just because of the regulatory problems. You've seen them go in front of Congress, and with Facebook now, you have to love Facebook's revenue improvements that they've been putting up. Their numbers are pretty incredible, but it could be dead money for a little bit of time. Rather than that, we'd rather go into something like a Home Depot. We think it's time to buy Boeing. They've had their problems, and those problems are mostly behind them right now. And if you need something smaller, we wouldn't even suggest something like a Roku. You guys were talking about that earlier, and we believe that could be the aggregation system or like cable for over-the-top systems.
Roku not having a good day today, and Boeing has had a string of bad days. Tell me why you think Boeing's worst days may be behind it.
They've done extensive investigation, and once those planes get in the air, you're going to want to be an owner of that stock, and you're going to be very thankful that you got into it today at kind of the inflection point rather than waiting until it was all clear in the skies to go back into the stock. Once it's all clear, I think a lot of the recovery is going to be already put into that stock. We're probably going to see 400 next year on that stock.
Jeff Mills, you like emerging markets. That stood out to me. Why?
Well, I think if you just look at the chart as an example, you're starting to break out through this tight range that we were trading in. We're now above the 200-day moving average, which is finally starting to slope higher. So I think just the technical setup is good in combination with some of the things happening with trade on the positive side. I think you could actually buy into emerging markets here and stick with that rally for a little bit of time.